Welcome to the Red Wagon Estate Planning and Elder Law Show, hosted by me, yours truly, Jeffrey Bellomo, where we discuss all things estate planning and elder law, and well, hey, anything else we want to talk about. Now, today is going to fall squarely under estate planning and elder law, and actually, we are really going in the weeds today. We have been getting a lot of questions, and I stayed away from them because they were really detailed, intricate trust questions, and I just didn't think that it was appropriate for the podcast. But I'm a self-aware human being, and when you keep getting the same questions over and over again, maybe it is time to comply and to answer the questions. So what I want to start with today is, if you are a beginner and you are just enjoying these podcasts for the high level kind of fun, entertaining aspect of it, this podcast may not be for you. We are going straight into the weeds on this one. We are really diving into trust. We're answering some really difficult, tough questions. So if you're kind of not there yet, then that's okay. Maybe skip on to the next podcast. For those of you that are thirsting for knowledge and you really want to dive deep in, this is for you. This is absolutely for you. Before we begin, I do want to do the disclaimer as we always do. Remember, do not take what you're hearing on this show, or any other show for that matter, to constitute legal advice. If you are looking for legal advice pertaining to a specific situation, please contact a lawyer who is licensed in the state that you reside in, who practices in the area that you need them to practice in. Then and only then should you meet with them about your specific situation, and that would constitute legal advice. This show, and any other show, is for informational, educational, and entertainment purposes only. Okay, so this is to give you a nice idea, but if you're deciding to do this or you have specific questions, please speak to a professional that can answer the questions specific to you and to your situation. Remember, at Bellomo Associates, we offer free weekly educational workshops in the area of pre-planning or estate planning, crisis Medicaid planning, life care planning, special needs planning, as well as administration, both for trust and probate administration after the loss of a loved one. We offer them regularly. We typically have links that you can watch them pre-recorded, and in many cases you can watch them live on Zoom, or nothing better than being in person. We are in the state of Pennsylvania. We have offices in York, Pennsylvania and Lancaster, Pennsylvania, but we are able to assist people throughout the state of Pennsylvania. We'd love to see you at Bellomo Associates for one of our upcoming workshops. Okay, so the question that we're getting a lot is in our workshops, in our pre-planning workshops, where we are discussing estate planning, we talk a lot about trusts. And one of the things that we have been doing for a while now is, when we're teaching the style of trust that we are using for asset protection purposes, for the ability to have them protected from long-term care costs and other creditors, we are teaching basically what is a pure grantor trust. That means that it is in the individual's social security number, that they are in control because they are the trustee of the trust. So I know I'm diving right in. I haven't just explained it because we've done that in other podcasts. But the trusts that we're teaching are included for income tax purposes and for estate tax purposes, meaning that the person who is creating it, the grantor, will claim all of the income taxation consequences on their personal 1040 each year. And furthermore, when they die, because they control the trust, it is included for inheritance tax purposes, which means that, let's say the children inherit it, they're going to pay the 4.5% inheritance tax, but they will get a step up in basis. So for example, if dad has a trust and he bought a house for $20,000, at the time of his death, I, as the child, through the estate, will pay the 4.5% inheritance tax to the state of Pennsylvania. But now my basis in that property is $200,000, the fair market value on the date of death, which means if I sell it for $200,000, what is 200 minus 200? It is 0. So I will not pay the capital gains tax. So the trusts that we're using are great for real estate, highly appreciated investments, stocks, all those kind of things, because we want that step up for the children to avoid the capital gains tax. Now, in my workshops, we teach revocable trusts and asset protection trusts. And in it, what I say is, okay, I'm going to teach you revocable, how you can reach in, give it directly back to yourself, and you can close it, you can nullify it, you can shut it down, you can take the money and walk away. Now, debtor-creditor law says that if you have the right to do that, so too do your creditors. Meaning, revocable trusts are for probate avoidance, not for asset protection. I then teach a trust that is called an asset protection trust. But in reality, it is a pure grantor irrevocable trust. So my number one tip is do not Google irrevocable trust. I say that all the time. Today on the podcast, I'm answering directly why do we say that. For years I have been saying the problem in the area is not competition, it's not other attorneys knowing what we're doing, it's not other professionals, it's that they don't know what we're doing. It's that they don't understand it. It's that if you Google irrevocable trust, the only thing you're going to find is information about tax trusts. Tax trusts are for people currently with more than $13.61 million. This is being recorded in 2024. So an individual can have 13.61 million. If they are married together, they can have another 13.61 million. All right, so I believe that's what, like 26.22 or something like that. We're talking lots and lots of money, right? That is not what we're talking about. Our clients at Bellomo Associates do not typically have those kind of assets or wealth. In fact, we currently have 0 clients that have more than 13.61 million and more than 13.61 million, right? So what is that, 27.22 million or whatever that number is? It is a big, big number that doesn't apply to the people that we are working with or that we're talking about in the workshop. So what we're teaching is a trust that allows us to get asset protection. Now, how do we get it? Because we're giving up the ability to give it directly back to myself. But let's use the house, for example, right? A typical person puts the house in a trust. They're allowed to live in it, they can sell it, they can buy another one. If they live in it 2 out of 5 years as their primary residence, they still get the same capital gains tax exemptions up to that amount of money that is applicable that year. Everything is the same. It is still in their social security number. They still get the 121 exclusions. We still get the step up on basis for the kids. Everything is the same. But if a person Googles irrevocable trust, they are going to find about tax trusts that are non-grantor trusts. They are not in the social security of the grantor. They have to file separate trust tax returns. They have to pay higher trust tax rates. So that is not what we are talking about. That is not the style of trust. So why I'm saying don't Google it is because you're not going to learn about the type of trust that we are teaching. And ironically, I had a client yesterday who has been a long-term client of ours who decided to upgrade recently to this style of trust, was talking to his professional, his accountant, and the accountant was saying everything about tax trusts, everything about non-grantor irrevocable trusts for tax purposes. Got him very overwhelmed, got him very worked up. Once I was able to talk to him, we cleared everything up, reminded him of what we teach in the workshop, reminded him it's a different style of trust. So I wanted to just kind of reiterate that the reason that we say that is because you're going to get yourself very confused. There is not a ton of information out there about the style of trust that we use because they are trademark licensed trusts by a national organization and you have to have a license to use it, and there are not all that many attorneys in the country that are using them. Now, been using them for years, tons of positive answers, tons of positive results, But we're not going to be posting it out there because it's very expensive to join the organization. It's very expensive to get access to these trusts. So why am I going to be posting it for free when I teach for the organization? People pay the organization to go. So that's why we say not to Google irrevocable trust, because you're not going to learn about the style of trust that we are discussing. Another thing that has been coming up a lot lately is I think that there is a complete misnomer about the purpose of trusts and how they work well with continuing care retirement communities. So the question that we have been getting a lot is, Jeff, if I decide that I want to go to a continuing care retirement community and I don't have enough other assets in my name alone that we call fund money, whether it be retirement accounts, whether it be just assets in your name, your Social Security, your pension, other investments in your name. If there is not enough other stuff and I need the assets in the trust, sure, you can change your mind. Most CCRCs will allow you to sign a piece of paper that gives them access to the trust if you agree to it, and if they want to do that. You could always terminate the trust. There are ways to terminate the trust. I won't go into that on this podcast. That's really getting in the weeds. But there are ways to terminate it and follow the Uniform Trust Code. So we can certainly do that. We can certainly get you in a position where those assets are available. But generally speaking, for people who want to go into a continuing care retirement community, we are having that question up front. We're having that conversation up front, which means we're going to leave out enough money to get you into the continuing care retirement. We're just putting the excess money above what the buy-in would be or what the amount of money would be that you would need to get in there. And in that case, we probably already planned for it. So if we already planned for it, then it's no big deal at all. If you didn't think you wanted to go to a continuing care retirement community, and all of a sudden you completely change your mind and now you want to go and you don't have assets, yes, we could absolutely change our mind. We could absolutely undo it or just make the assets available to continuing care retirement community if that is something that needs to occur. But generally speaking, it probably won't. And yes, we can get the funds out. Another mechanism that we may use is to have, instead of terminating the trust, we may have the grantor, the person who created it, write a check to the kids and then have the kids give it back or give it to the continuing care retirement community. But the short answer is yes, it's okay if you end up changing your mind. You're certainly not doing this and, can never change your mind. There are mechanisms to do it. There are mechanisms that would allow that to occur. But hopefully we planned for it, and hopefully we left enough out, and hopefully you can still get in where you want to go and protect a little bit for your family above the amount that they need you in order to be able to get in. Another question that we're getting a lot is when we start talking about real estate in trusts, what are they allowed to pay expense-wise from the trust? So I think the first thing we have to do is separate primary residence from not primary residence real estate, right? So the primary residence is the house that the individual lives in as their primary residence. It's where they sleep at night. It's where they live. And then any other real estate, that might include mountain properties, beach properties, rental properties. I mean, that could include anything other than the primary residence. Let's start with anything other than the primary residence because that's easy. If the house is deeded in the name of the trust and it is not a primary residence, the trust can pay for everything. Why? Because the trust owns the house. Now, who controls the trust? The grantor, probably, in the style of trust that we're using, which means that if you create it, you're the one in control of it. But technically, you don't own it. The trust does. But remember, all of estate planning comes down to control and access. So if I'm the one who can control it, I'm the one who can sell it, I'm the one who can buy another one, I'm the one who can rent it out, I'm the one who can enjoy it, I'm okay with the fact that I don't own it as long as I control it. So that's easy. In a non-primary resident situation, the trust can pay for all expenses, taxes, utilities, furnace, roof. If you can think of it, the trust can pay for it. Where we have a little bit of a different answer is with the primary residence. And let me give you the why behind it, okay? The why behind it is different is because you are transferring a property to a trust. You don't technically own it anymore, and you have the right to live there. So, in order for, let's say, the government, let's just use that word, to be okay with it, we basically need to see that you are paying fair market value to live in the house. Now, fair market value to live in a house, is what somebody would pay to rent it. In this situation, it simply means that the person has to pay taxes and utilities. I mean, we basically want to see that you're paying the taxes and the utilities. Now, most of us agree that if you're paying fair market value rent to a third party, it's way more than just taxes and utilities, right? I mean, there has to be a profit built in there. They have to get extra money in case the furnace breaks. And, there's definitely going to be a lot more that goes into it. So with the primary residence, pay the taxes and the utilities personally. So that will come out of the fund money. That will come out of the money in your bank account. So you will go ahead and just keep paying the taxes, the utilities. If there's a mortgage, you want to pay that personally as well. Just keep living your life the way that you normally would, writing the checks to pay for those things. Now, when it comes to real major expenses like a roof, I always tell people, if you want to be black and white, go ahead and pay for it personally. But I have not had any issues with the trust paying for those because those are not considered fair market value to live in the property. When you get into major expenses or major repairs, it is okay for the trust to pay for those items because that certainly goes way above and beyond paying fair market value, taxes and utilities and mortgage to live in a property. So that I think is a great rule of thumb. If it's just kind of run of the mill everyday stuff, absolutely. If it gets as a major expense, then it's probably going to be fine for the trust to pay the expense. The document itself will spell all that out. So if you're trying to figure all that, just take a look at the document. It will certainly kind of give you insight into what can be paid. If you're a client of Bellomo Associates, give us a call. And remember, we give you trust guides. We give you videos. Don't let your trust trip you up. You have access to all of those informational tools, which also explain all of this in them if you're a client of Bellomo. If you're not, then this will give you a good rule of thumb to kind of understand holistically or big picture wise to go from there. Another question that we've been getting a lot is, how do I know if it's too late to do a trust? That's a phenomenal question. I think that what I'll do first is I will teach the V. So the V this is pre-planning, this is crisis planning. Notice that the V goes away from each other, right? So what that means is if I do my pre-planning and I do my will, my financial power, my medical power, I do my asset protection trust, if I do anything like that, that puts me out on the left side of the V. If it's 6 months later and I fall and break a hip and I have to undo the trust or I have to go to a different planning option, I have to come back to the beginning and I have to go down crisis or the other side of the V. So what that means is the goal is to make it through the 5-year look-back period. Stay out of the long-term care facility for 5 years and do not apply for Medicaid, right? So we control that because all we have to do is not apply for Medicaid. That's when the look-back period is triggered 5 years back. It's when we apply for Medicaid. So if I'm in a situation where somebody is 4.5 years in, I'm probably going to pay privately for the care. And in a difficult situation, I may even take money out of the trust through the children or through the beneficiaries and still be able to pay for the care that's needed in order to get me to the 5-year look-back period. So we control that because as long as we don't apply for Medicaid, the 5-year look-back period isn't triggered. So it is possible to be able to use the money in the trust to help us to get to the 5-year look-back period because we control when the application is filed. So with all that said, The question really is, when is it too late? What I always tell people is if you're confident that you're going to need a long-term care facility within a year, I wouldn't probably do the trust, because currently in the state of Pennsylvania, there are crisis planning techniques on the right side of the V that are still viable, still work, still will do a very good job. In a married situation, we can still protect 100%. In a single case, we can still protect 50%. Still great results. So if that's the case and you know that you're going to need a long-term care facility within a year, I say don't even bother doing the trust. Let's plan on crisis. Come to the crisis workshop, get yourself educated, start understanding what you're going to need as far as 5 years of statements, understand the crisis process. If you think that you're definitely going to make it 5 years and stay out of a nursing home and not apply for Medicaid, then I think the pre-planning side is also very clear. If you're somewhere in the middle, that's where it becomes a little more difficult. Generally speaking, we say, you know what, as long as you think that you can kind of stay out and not need a long-term care facility or have other funds to pay for, at least 2 years to 3 years, then it might be worth kind of trying it. We can always undo it. We can always kind of go back to basics or back to the beginning and still go down crisis. But, there's a lot that would go into that decision. We definitely had some people that did a trust and ended up 6 months to a year needing long-term care. We were able to kind of come back to the beginning and go down crisis and still protect assets. You're not out anything other than the money that it costs to create the trust, but you still get discounts on the crisis side. We can still then go back afterwards if there's a spouse and use the trust. So there's still some things that can be done, but we do kind of want to feel somewhat solid that we think we can get into the 5 years in order to create a trust. But as long as we don't trigger the Medicaid application or file the Medicaid application, the 5-year look back never starts. So we're in control of that. So I think that's a lot of what would go into, is it too late? Biggest question I would ask myself is, do I think that I'm going to need long-term care in the near future and I don't have a way to pay for it otherwise? So if you're somebody who has a very good long-term care policy, doing the trust might make sense, so that'll help you get to the 5-year look back. You'll use the long-term care policy during the 5-year look back to get you further into it. So that'll buy you more time. Or if you're sitting on another asset that you're willing to kind of use privately, again, another thought that will go into it, another thing to consider if you're thinking about it. If you don't have those things and you know that you're going to need care within the next year, I probably wouldn't do the trust. I would come to the crisis workshop and really start understanding what that looks like or what that would entail for you and your family. All right. So I think that kind of answers the question about, is it too late? We talked about the expenses coming out of the trust. We talked about, what if I change my mind and I want to go into a CCRC? And we also talked about why we say you shouldn't Google trusts if you're working with our office and you're learning about these style of trusts. The last thing I want to end with is, I use the term asset protection trust, right? And I use that because I don't want to use the actual term irrevocable, because everybody thinks it's a tax trust. But something that also came up recently was a client researched asset protection trusts. And what they found was these domestic asset protection trusts that are approved in 9 states across the country. That is not what we are talking about. I'm using that term asset protection in a different context. I'm using it in that it's providing asset protection for you. I'm not teaching a domestic asset protection trust. For years, what I have been saying is, there's going to be problems with any type of trust that violates principles or that violates trust or tax laws, right? If you're defying basic principles of tax and trust, they may make an exception for it in the short term. But in the long term, something is probably going to happen. I had been preaching for years about, you cannot have an asset that is excluded for estate tax purposes and still get your kids a step up in basis. That just doesn't work. That defies logic. And this year in January, the Department of Revenue agreed and said, no, we're no longer going to allow you to do, I apologize, it wasn't the Department of Revenue, it was the IRS. We're not going to allow you to do an intentionally defective trust that's excluded for estate tax purposes and still give kids a step up in basis. We're not going to allow that. I've been calling that for years. It's the same with a domestic asset protection trust. They fly in the face of basic trust principles. They allow the grantor to do things that you cannot be allowed to do and still get debtor-creditor protection. There will be a day when those go away. There is a reason why they're only allowed in 9 states. And frankly, they're generally for people who have millions and millions and millions and millions of dollars. They're not for the type of people that we are teaching this style of trust for. So that is not what I'm talking about either. So that's why we always joke and say, don't Google, right? Learn the information, get educated, listen for yourself, and decide if you think that the people that are teaching it understand or know what they're doing. It's very specialized knowledge. It's very detailed information. So Googling is very, very risky because you're not going to get what it is that you're specifically addressing or what the actual trust is. So that's why we talk about it. I did want to mention the Domestic Asset Protection Trust as well. I didn't do that earlier, so I wanted to kind of end with that today. Now, I know today was a deep dive into trust. It was a real deep into the weeds. I had fun. This is the stuff that gets me excited. This is the stuff that makes me really enjoy what I do. Real detailed, specific information. I hope you enjoyed it. We'd love to see you at one of our upcoming workshops at Bellomo Associates. You can check us out on the web at www.bellomoassociates.com or give us a call at 717-845-5390. We have all of our weekly workshops on our website, and we also offer a professional boot camp for both healthcare and financial professionals. We offer them several times a year. You can go on the website and check that out. If you want information, if you're a professional, on how to get 6 free credits, we have it approved for insurance, CPA, CFP. On the healthcare side, we have it approved for certified nurse practitioners, registered nurses, social workers, family and marriage counselors, and many, many others. So if you're a professional and you're in the York, Lancaster area, please check us out. Take a look at what the upcoming dates are for upcoming professional boot camps or for one of our workshops. We would love to see you there. Thank you so much for joining us on this episode of the Red Wagon Estate Planning and Elder Law Show, hosted by me, yours truly, Jeffrey Bellomo, where we discuss all things estate planning and elder law. Today, man, we had a lot of fun. We did a very deep dive into trusts. I hope you enjoyed it as much as I did. And until next time, we'll see you real soon.